Most people think crypto trading means spot trading or basic futures on exchange like Binance, but there is a new generation of protocols changing how derivatives are traded on chain. Today, we are talking about Variational, a centralized derivative protocol that's quietly building infrastructure for the next era of crypto trading. This is not a meme project. This is not a hype. This is a serious trading technology. And by the end of this video, you will fully understand what is variational, how it works, and why it is different and who it is really for. Stay to the end of this video. Firstly, let's talk about the problem variational solving. Starting with the problem, traditional crypto exchanges have three major issues. One is centralized control. Your funds are held by an exchange. Two is order book, limitation of a poor liquidity for many assets. Three is the high fees and hidden costs, especially for active traders. Even many decentralized exchanges still relies on order book or AMMS that struggle with complex derivatives like options or custom futures. Variational was built to solve this problem from the ground up. Let's talk about Variational. Variational is a peer-to-peer on-chain derivatives protocol. Instead of using an order book, Variational uses a request for quote system, also known as RFQ. Here is what that means in a simple terms. A trader requests a price for derivative contract liquidity provider. Respond with a quote, the best quote is selected and the trade is settled on-chain. No centralized exchange, no hidden counterparty, no forced liquidity from backbox system. How Variational actually work? Under the hood of Variational, this allows a bilateral contract, which means two parties agree on trade terms. Settlement is forced by a smart contract, margin leverage, expire, and a payoff are customizable. This structure allows trading of perpetual futures, fixed expire futures, optional structures, derivatives. All this without relying on centralized intermediaries. Variational for a retail trader about Omni, which is Variational retail friendly trading platform. Omni is where everyday traders interact with Variational without needing advanced knowledge. Key features of this Omni are zero trading fees, tight spread, fast execution, access to hundreds of tokens, built on Arbitrum for low gas fees. One standout feature is the loss refund mechanism, where some losing traders may be partially refunded through incentive programs. This is extremely rare in crypto trading. This only uses liquidity provider or OLPs. This liquidity provider pull pricing from centralized exchanges, decentralized exchanges, OTC DEX, professional market maker. This aggregation allows a deep liquidity even for assets that normally suffer from a leakage. In a simple terms, you get better prices even on volatile or smaller tokens. Beyond Omni, Variational also has a Pro. This is built for institutions, funds, advanced trader, OTC DEX. Pro allow custom derivative contracts with automated clearing, on-chain settlements, reduced counterparty risks, and this also bridges traditional finance and DeFi derivatives. Talking about the security of funding credibility, Variational is not an experimental toy. The team has raised over $10 million from reputable investors, is actively building in a private beta and operates transparently through its documentation and community. This gives it long-time credibility. Variational is best for serious trader, derivative user, people who understand leverage, traders who want non-custodial execution. And this is not a beginner's gambling education, and risk management are essential. If you want more deep explanation like this without hype, without noise, subscribe and turn up your notification bells on. I only focus on a real infrastructure before it go mainstream. See you on to the next video, and thanks for watching.